Imagine this for a moment. You wake up one morning ready to finally buy the car you VA dreamed of for years. Maybe a S. A fuel-efficient Toyota Camry. Maybe a safe family SUV. Maybe even a brand new Tesla that you've been seeing all over your neighborhood, but just when you feel excited, reality hits you hard. How am I going to pay for this? And that's exactly the moment where millions of Americans silently panic. Because buying a car in today's USA, where interest rates are higher, prices are unpredictable, and lenders are stricter, feels like walking into a maze with no map. But what most people don't realize is that they actually have two financial paths in front of them. And both can lead to the car they want. A traditional car loan from a bank or dealership, or a policy loan against your existing life insurance policy. And the shocking truth, most Americans don't even know policy loans exist, even though they could save you thousands of dollars, remove complicated credit checks, and give you full control over your repayment schedule. But wait, before you think policy loans are some magical perfect solution, you need to understand that both car loans and policy loans come with benefits, dangers, traps, and secrets that no dealership will tell you, no banker will explain, and no insurance agent will fully break down for you unless you ask the right questions. And in this video, we are digging deep into the real numbers, real risks, and real opportunities, so you don't make a mistake that affects your money for years. Now, let's start with how car loans actually work in the USA, because this is where most people lose money without even realizing it. A standard car loan means you're borrowing money from a bank, credit union, or dealership, and you agree to repay it over a fixed term, usually 36, 48, 60, 72, or even 84 months. Sounds simple, right? But here's the catch. The lender decides your interest rate, which depends on your credit score, your income, your down payment, and even the type of car you are buying. For example, a person with a 760 credit score might get a 4% interest rate, while someone with a 620 score might get a 13% rate, and someone below 600 might be offered a shocking 20% plus interest rate, especially from dealerships that specialize in bad credit buyers. And the trap gets deeper. The dealership often adds hidden fees, extended warranties you didn't ask for, and extra charges buried in the paperwork. On top of that, car loans almost always require a credit check sometimes. A hard inquiry that drops your credit score instantly. And if your income is unstable or your debt-to-income ratio is high, lenders may refuse you altogether or push you into a more expensive loan. But here's the part that surprises people. When you take a car loan, the lender you technically owns the car until the loan is paid off. Miss payments. Your car can be repossessed within weeks. And yes, repossessions are rising across the USA because people are overstretched with payments they can't manage. Now let us switch gears and talk about something almost nobody is prepared for. Policy loans, a hidden financing strategy built into many life insurance plans, especially whole life and universal life insurance. If you have a policy that builds cash value, you can borrow against it at any time. And here's where things get interesting. Policy loans do not require a credit check. They do not affect your credit score. They do not have fixed payment deadlines. They do not include hidden lender fees. And they allow you, not a bank, to be in control of how fast or slow you pay the loan back. Think about that. If you lose your job, take time off, or face a financial emergency, the insurance company won't call you, threaten you, or repossess your car. You choose the repayment schedule. That's a level of flexibility no traditional car loan can match. And while car loans lock you into monthly payments for several years, a policy loan lets you say, this month I'll pay, next month I won't, and no one will punish you for it. But hold on, you might be thinking, if policy loans are so great, why doesn't everyone use them? And that's the truth. Because most people don't. Do you have the right type of life insurance that builds enough cash value to borrow from? Most Americans only have term life insurance, which is cheaper but does not build savings, so it can't be used for loans. Policy loans require whole life or universal life, and these policies take time to grow. If your policy is new, you can borrow much. But if your policy is old, or maybe 7 or 15 years old, you might have thousands of dollars sitting there, waiting to be used. Here's where suspense kicks in. One policyholder I studied at over $23,000 in available loan value And didn't he even know it? He was about to take a dealership loan at 14% interest, but after learning about policy loans, he borrowed against his policy at a 5% interest rate. Saved a huge amount of money, and the best part, he paid himself back instead of paying the bank. Because with policy loans, the interest you pay often goes back into your policy, not to a bank. But here is the risk that nobody talks about. You must know this before choosing a policy loan. When you borrow against your policy, the insurance company uses your cash value as collateral. If you don't repay the loan over time, your cash value decreases, and your death benefit can shrink. If the loan grows too big, your policy can collapse. That's why policy loans require discipline. They're flexible, yes, but they're not free money. And here is another warning. If you take a large policy loan and let it sit for years without paying it back, the interest can compound, and you might owe more than you expected. So if you're planning to use a policy loan to buy a car, you need to understand exactly how much you should borrow, how fast you should repay, and how it affects your long-term insurance plan. Now, let us break down the direct comparison between car loans and policy loans in a way nobody has ever explained. Imagine you choosing between two roads. The car loan road is bright. At the beginning, it's popular, easy, and straightforward, but full of hidden traps, easing terrorists, credit checks, repossession risk, and strict payments. The policy loan road is quieter, less known, but full of freedom. No credit checks, no banks, full control, and potential long-term savings. But only people who built their policy cash value early can walk that road. For someone with bad credit, policy loans can feel like a miracle, because car loans with bad credit are extremely expensive, sometimes adding thousands of dollars in interest alone. For someone with good credit, a car loan with a low rate might still beat a policy loan if the insurance company charges a higher loan rate. So the real question isn't which is better. The real question is, which option fits you our financial life, your credit score, your policy, and your long-term goals. And here, that's where you need to be smart. If your policy has strong cash value and you're redisciplined with money, a policy loan can save you interest, give you freedom, and help you avoid debt stress. But if your policy is new, or the cash value is low, or you're not good with repayment, a traditional car loan may be the safer option. Now let us talk real numbers. The average car loan in the USA today ranges from 5% to 16% interest, depending on credit. Meanwhile, many policy loans come at 5% to 8% interest, but with far more flexibility. Another huge benefit: policy loans don't hit you with late fees, bank charges, or penalties. They simply accrue interest quietly until you repay. But here comes the twist. Some insurance companies use what is called a variable loan rate, meaning the interest can rise over time based on the market. And some use fixed loan rates that stay stable for decades. You need to know which one your policy uses. A lot of people don't. Now let us address what nobody wants to admit. Car dealerships love when customers don't understand financing. They make more money from loans than from selling cars. So they push people into expensive loans because the customer doesn't have savings or alternative options. But you now know an alternative. Most people don't. You now understand the difference between borrowing from a bank versus borrowing from yourself. You now understand how policy loans give you flexibility and control, but also responsibility. And before we end this deep dive, hear us the most important message. The best choice is the one that keeps you financially safe, stable, and stress-free, not the one that looks easiest today. If you have bad credit, consider a policy loan. If you have great credit, consider a low-interest car loan. If you want total control, use a policy loan. If you want predictable payments, use a car loan. If you have no policy cash value, don't force I choose a car loan responsibly. And now, as we close, here's your call to action. If you have questions about policy loans, car financing, life insurance, or cash value, drop your questions in the comments below. I reply to every question personally, and your question might even get featured in the next video. And if you found this explanation helpful, don't forget to hit like, subscribe to the channel, and turn on notifications so you never miss the financial knowledge that can save you thousands of dollars. Your financial power begins when you understand your options, so stay smart, stay informed, and I'll see you in the next video.